Hey, Seth David here, talking about how to use QuickBooks Online to handle accounting for startups. Now, if you read the write-up, and I highly recommend you reading the write-up, if you're on YouTube, first of all, please subscribe to us on YouTube if you haven't already. Secondly, check the description below for a link over to the write-up where you can see a much more detailed write-up right on SethDavid.com. And of course, you can access all the other content that I've created, a small mountain so far, on accounting for startups. So I've done a series on what you do when you're sort of bootstrapping and really can't even afford to pay the monthly fee for QuickBooks Online. The trick to that, by the way, is to get with a pro advisor like myself who has a wholesale account with QBOA, and then we get it for about half the price of what you'd pay for it. So hire us to help you with the accounting, and in my case, I just include QuickBooks Online in the cost, in my monthly fee. So that's always an option. Reach out to me if you're interested in that. Just give me a call at 866-945-8070 or send an email to seth@nerdenterprises.com or fill out one of those awesome little contact forms that I provide for you on both sethdavid.com and nerdenterprises.com. All right, got the call to action out of the way. Now let's get down to business. So there's two major things I want to kind of walk you through in terms of, sort of your first lesson here in setting up your accounting when you're using QuickBooks Online to handle the accounting for a startup. And we want to look first of all at what happens when you first put money into the business. Now, in the write-up, I described that when you go through the setup process, you're going to be asked to choose an industry that essentially drives your chart of accounts, which then can be found among other places here. This is just where I've gotten in the habit of going. I like using this left-hand menu a lot. And over here under transactions, you'll find the chart of accounts. Why? Because all of your transactions ultimately live somewhere within your chart of accounts, oftentimes in more than one place, because every transaction has a debit and a credit to it. So, for example, if I write a check to pay for an expense, then it lives in two places. One is the bank account that I wrote the check out of, and the other one is the expense account, which is going to appear somewhere down here in the chart of accounts. Now, your accounts are broken up into, essentially 5 different sections. We have assets, we have liabilities, we have equity. Those are your balance sheet accounts, assets, liabilities, and equity. And then we have revenue and expenses, which are the accounts that you'll see on your profit and loss statement. All transactions have to affect at least 2 accounts, sometimes more. So I'm going to focus your attention on the equity section of the balance sheet, which you can see right here. And notice here, this is kind of a bare bones company. I had actually used it for another industry, and I just went and wiped out all the transactions so I could kind of start over for you guys. And so we have kind of the bare bones, and this is what QuickBooks will start you off with, which is this opening balance equity account and retained earnings, which is a system account. So you're not often going to want to mess with that. And the first thing I want to have you do, especially with a startup, I think it's so important because you're going to be funding money into the business, likely taking money out of your own pocket and pouring it into your business until you're ready to bring on some kind of venture capital or venture funding. So this is how we want to set this up. If we go to the top here in the chart of accounts, we're going to click New. And over here, we have to choose the category type. So you're going to choose equity. And we're going to set up a series of accounts here. First of all, we're going to, and let's say you aren't the only one. Let's say it's you and one other person who owns the company. So in other words, you have a partner, and maybe you haven't decided what kind of company you're going to form. Maybe you're still a sole proprietorship or a partnership if you're bringing somebody else in. I highly recommend you get with an attorney and form an entity, maybe an S Corp, maybe an LLC, depends on the nature of your business. And that's something that you should go on the advice of your CPA and or attorney in terms of what entity type to choose. Generally speaking, here in California, the way I guide my own clients is S Corp, unless you're in the real estate business, then we do an LLC. And there's reasons for that, which I could get into in another video. So let's just say we have an S Corp, right? So with an S Corp, the owners are shareholders, right? With an LLC, the owners are members. With a partnership, the owners are partners. So the nomenclature changes based on the type of entity, but the structure and the concept is exactly the same. We're just using different language. So let's say it's an S Corp, so we have shareholders. So I want to do shareholder capital. And if it's me, I'll say Seth David. Okay, that's one account. We're not done. So we're going to just save and new. And I'm just going to copy that to the clipboard because it's going to save me a minute and another second. All right, then we're going to go to another equity account. And we're going to call this shareholder contributions. So this is for money that I put into the business. And again, I'll copy that just to make it a little easier. One more time, equity account. And this is for shareholder distributions. And I don't know what just happened here, so let's try that again. Okay, and I forgot on the last one, this needs to be a sub-account of shareholder capital Seth David. I'll go back and fix the other one. So make sure it's a sub-account. And now we're done, so save and close. And let's get down to the equity section and fix this one. So back in the chart of accounts, if I need to make a change to an existing account, I find the account here in the list all the way to the right, click the drop down and choose Edit. And I want to make this a sub-account of shareholder capital Seth David. And now we have a nicely structured equity section here where it has my capital, what I've contributed, what I put into the business, and what I've taken out in distributions, what I've taken out of the business. And what this does is it paints a really nice picture on the balance sheet report, which is where these accounts are ultimately going to show up. That will show me very clearly, here's what I put in, here's what I've taken out, and here's what it totals to. So it creates a really nice, clean structure, and I think it's especially important as a startup to do this because you want to keep very careful track of every penny that you put in and taken out. And especially if you have a partner or another shareholder that you own the company 50-50 with, or whatever the ratio is, you'll create another section just like this for every owner in the company. Everybody who's got a stake gets a section just like this, a parent shareholder capital account, and within that, your contributions and your distributions. You could use one combined account for both of these, but I don't recommend it. I think it's much cleaner to show them separately. This is one area I talked in the write-up about how you don't want to have too many accounts. You want to keep it simple because you can drill in and get the details when you need to. This is one of those situations where that rule doesn't apply. I want the details here. I want this much detail, at least, right on the surface, right at the top of the balance sheet. So now that we've got this set up, we can talk about the first major thing, which is how to deal with money that you put directly into the business. And now it's going to get real simple. But as always, and in my usual style, before we even go there, I want to run a balance sheet report. So if you go into the recommended, I went to reports here. I did that a little fast. I went to reports here on the left. And we go into recommended, and you're going to have just that. These are the reports that you're most likely going to most frequently want to run. And of course, the profit and loss and balance sheet are included there. So if I run the balance sheet, I'm just going to run it for all dates and click Run Report. The question of cash or accrual is going to come up. Always do accrual. I always joke with my clients, this is a bad accounting joke. It's a cruel world. You're going to have probably your accountants or your enrolled agent and people who are doing your taxes for you try and encourage you to do cash basis, and I want you to tell them, Seth said no. And the reason is, for their purposes, yes, it needs to be done on a cash basis, but that's why we have the ability to change this to cash basis when we're running reports for them. But you cannot, I'm going to repeat this, you cannot run a business on a cash basis. What that says is I'm going to ignore my receivables and ignore my payables and pretend like I only have a business going when I receive money by way of income for something I've sold and when I actually pay for something. But without looking at receivables and payables, how am I supposed to keep track of bills that I haven't paid yet or money that I've invoiced for and haven't received yet? Cash basis ignores that. It says it's not income, it doesn't exist until I get paid or until it's paid. So accrual. You have to run a business on an accrual basis. You only file your taxes on a cash basis. That's the only purpose that running reports on a cash basis serves. The other exception might be, and I'll admit that I do this sometimes, is sometimes I do want to run a report on a cash basis just for a minute because I want to look at things in terms of only what's come in and what's gone out. But I still cannot run a business from the big picture view without doing it on an accrual basis. So I hope I've driven that point home pretty solid. So if you have any questions, you know what to do. Post your comments and questions below. So we're going to run the balance sheet on an accrual basis, and notice this report does not contain any data. So as you can see, no tricks up my sleeve. I run it for all dates. Like the balance sheet, you can't hide anything from the balance sheet. Any transaction that you ever post will affect the balance sheet. The same isn't necessarily true for the profit and loss. So if there's any transaction on the books anywhere, there will be an impact somewhere on a balance sheet account. Even if I record some income and on a cash basis, right? That means I've received the money, so it's going to hit a bank account. And I'm going to record income, which means it's going to show up in the equity section of my balance sheet. So anyway, the bottom line is balance sheet will always show everything, especially if you're running it for all dates. So when you run a balance sheet for all dates and there's nothing there, you know for sure there's not a single transaction recorded on these books. So now let's go put in that initial deposit, that money that we're putting into the business on the day that we started and finally opened up a bank account, right? Then we're going to go back and deal with what happens before this, before you have a bank account and you're spending money out of your own pocket, and how to handle that. So let's say we started this business on June 1st, right? Nice clean starting date. And we put the money in the account. So we're going to go to the account, and where do you think we're going to go? Where are we putting the money's going into our Wells Fargo operating account. But remember the accounts we just set up. We have shareholder capital, and then we have contributions and distributions. So I'm going to give you a second to think about it. You should know the answer because I just said it a couple of minutes ago, where this is going to go. Shareholder contributions, because we're putting money into the business. So let's say we're opening the account with $10,000. And under receive from, you could do something here. So I have some sample customers in here from when I was using this company file for a real estate example. So I'll set up a new company, and or a new customer rather. And let's just call this owners or investors. And I'm going to, and this isn't in the write-up, so this is kind of a bonus. Owners or investors, let's add it as a customer, and I'm going to save that. But then what I want to do is put myself in there. So if you put a colon at the end and type something new, it understands that you're trying to set that up as a subgroup within. At least it should. Let's find out. Works on desktop. Yep, so now that I click the drop down, you can see I've got owners or investors, and then within that, Seth David. And again, you'll set up a new instance of that for each other shareholder or owner in the company. And let's hit save and close. And it's warning me about classes. We'll get into that in another video. And boom, there's our balance sheet. And now it lights up. I've got my operating account with $10,000 in it, and notice it shows up that I've contributed $10,000 into the business. Nothing happening yet that affects the profit and loss statement. It's all on the balance sheet. I put money into the bank account, and now the equity section reflects that I've contributed value into the company. This company is now worth $10,000 because I put cash into the business equal to $10,000. Now let's go back in time before we set up the bank account. And let's say we were paying for stuff out of our own pocket, out of our, out of our personal bank account. We don't want to put a personal account on the company books. We've got to keep that stuff separate. But there is a way to account for it. And I'm going to take you back to our chart of accounts. And right at the top, right in the asset area, is where we have our Wells Fargo operating account and all our other assets. We're going to create a new bank account. So up here, we're going to say new. And this time it's going to be a bank. And cash on hand is perfect. And but we're not going to call it cash on hand. We're going to call this petty cash. And then sometimes I like to put paid from personal in parentheses, because petty cash is kind of an old sort of legacy kind of account that was probably more applicable before we had the kind of technology that we've had for a long time now, where people would actually keep petty cash in a petty cash box somewhere in the office so they could take cash out of it and go pay for office supplies. It was a whole different process. These days with debit cards, it's not only not necessary, it's actually less secure, right? Because cash can be stolen, so you're better off keeping your money in the bank and using debit cards or credit cards to pay for stuff like that. So we're going to create this just as a vehicle, because as I mentioned in the write-up, I don't want to have you having to post journal entries, but I want to give you a way that you can easily record that stuff that you paid for out of your own personal account. So now, just like any other bank account, you can write checks out of this account. So let's go to this plus sign, which is called the Quick Create, and under vendors, we'll choose check, right? Or you can just do expense. There's really not much difference between an expense and a check, other than the fact that a check will have a check number associated with it. So it's probably more appropriate to do an expense, although, let me back up on that. One argument for using the check is that if you paid for it out of your personal checking account with a check, you might want to put that check number on here so that if you ever need to, you can reference this back to the source, so to speak. Our account is going to be the petty cash paid from personal. So let's say I went and started off, I needed to buy some office supplies. So we go to Staples, all right? And let's quickly add Staples in as a vendor. Incidentally, after I typed the name, I hit the tab key, and then it figured based on my hitting the tab key that I was done with entering that particular field or piece of information. And then it says, hey, we don't have that name. Do we want to set it up? And it assumes because I'm doing a check that it's probably a vendor that I want to create here. And it would be assuming correctly. So let's click Save. And then the account here would be office supplies. And that's an expense. So again, we have to create the office supplies account. It's not on there yet. And you always have to choose a detail type. So we'll just put that in the detail type under Office General Administrative Expenses. The name is still Office Supplies, and let's hit Save and Close. And let's just say we spent $150 on office supplies. Okay, Save and Close. And again, it's yelling at me about classes. Don't worry about that for today. Let's go back to our balance sheet and see what that looks like now. And again, I'll run it for all dates. So there's my negative $150. And notice I recorded an expense now. So if I run the profit and loss, I'll see a $150 expense, no income, $150 net income, and that flows over to the balance sheet, to the equity section to close out. When I have a loss, that basically reduces the value of my company. So now my company is only worth $9,850 because I spent $150 out of it and I haven't earned anything yet, right? So that's how the balance sheet balances. And so what's going to happen is you can begin to see is as I record all these expenses, all these things I paid for, and I forgot to mind the dates. So this I know I booked on June 1st. Correct. Let's just go in. Yeah, that's on June 1st. Let's go back to the summary report. So this probably got booked on the same day. It did. All right, back to summary report. What's curious to me, though, is that I could have sworn when I first ran this, it said this month and didn't show up. I'm curious. Nope, there it is. Okay, anyway, I digress. So we're looking at an account here that's going to get more and more negative as we record more expenses. So here's how you deal with that. Now, let's say that these are all items that I paid for from my personal account, right? Then what we're going to want to do is we want to increase my contributions into the business because effectively, since I paid for it from my personal account, I've actually contributed another $150 into this business. So what I do is each month, at the end of that month, I record a deposit. So we're going to go to Quick Create, and we're going to go to Other and Bank Deposit. And so this is going to happen on, let's just say it was June 30th. And the account is going to be, again, shareholder contributions, right? And this time it's not going into Wells Fargo operating. We're putting a deposit into the petty cash. We want to zero that account out. And we're going to put it in for $150. So what this is going to do is it's going to zero out that petty cash account because we don't want to leave a big negative balance in that account. It's only a vehicle for tracking what we've paid for out of our own pockets. And then this, at the end of the month, assuming the 150 was the only thing, when I hit Save and Close, and I confirm yes on the classes, notice now this is at 0, and now my contributions are $10,150 with a net loss of $150. So the value of the company is still really $10,000 because I have now reflected the fact that I've contributed that $150 into the business, right? So the value is still at the net of what I actually, the $10,000 deposit that I made. It's really $10,150, but I spent $150. My friends, that's almost 20 minutes on how to use QuickBooks Online to handle accounting for startups. So sorry if I went on a little too long, but I thought it was important to cover this in pretty sufficient detail. Going forward, we'll have some shorter videos covering, narrow topics more deeply, but I think this is a great start for you to get started and get your QuickBooks Online company set up. Again, if you have any questions, if you need help, I'm available. I can work with you one-on-one. I can log in remotely with you and make sure that you get set up right from the get-go, and that's important. Getting set up right from the get-go is going to be really important. You want to build that right foundation so that when the time comes, when that VC funding company is looking at you and looking to give you $150 million, you've got solid financial statements that you can present to them with the confidence that comes with knowing that you're giving them solid numbers that are on a solid foundation here. So give us a call if you need help, 866-945-8070, Seth@nerdenterprises.com, or once again, fill out one of those awesome little contact forms that I've created. I worked really hard on them. Used a product called 17 Hats, which we're going to be doing some videos on also coming up shortly, in order to create those forms to make it easy for you to reach out to me and get the help that you need. As always, I hope you're having an absolutely fantastic day, and I really look forward to seeing you on the web.